Welcome. Thank you for joining the conversation about the 19 rules for getting rich and staying rich despite Wall Street. In this session, as in the past sessions, I'm going to ask you to go to your book and follow along certain passages, so please have your book available. If you don't own a book, you can buy one from your local bookstore, from our website, uniquereads.com, from Amazon, or wherever ebooks are sold. They come in hardback, paperback, and ebook format. Okay, let's get started. First thing I want you to do is to go to your brokerage online research pages. On those pages, you should find a place where you can create your own charts. And you can have charts of various kinds: daily, weekly, monthly, yearly, what have you. I want you to set up for each one of the companies that you selected a weekly chart for a 10-year period. All right? So it's a weekly chart for a 10-year period. Do that for every company that you have put into your personal universe. All right? Now, we want to keep in mind that no one knows the future. So trying to guess the future is illogical. What we want to do is to get a sense of both the absolute value of an investment as well as its relative value to its peers in its own economic sector. Okay? Now, the information that you're going to need can be found in your brokerage research pages online. So let's take one of the companies. Again, let's just use DuPont. Go to your brokerage research and plug in the number or the name DuPont. And when you get there, look for the tab that has income statement. Once you have that tab, you should have the income statement for at least the last 5 years. Preferably longer, but just the last 5 will do to begin with. Look down that income statement and find the line that says operating income. It also might be called earnings before interest and taxes, but operating income is generally the name they use. Populate your worksheet in your workbook with those numbers on the appropriate line that says in the workbook OI/EBIT. All right? Now go below the income statement on that same page, and you'll find numbers for the shares outstanding. See if you have a diluted weighted average shares, DWAS, diluted weighted average shares. If you find that number, put it on the row for DWAS in your workbook. All right. Now, the next number you want is the share price. Get the current share price and just sort of put it off to the side. And then you either can find the share price in the research pages. They might have that for the last day of the year, the end of the year closing price. All right. If they don't have it there, you can get it from one or two places. What I do is I go up to my chart, I put the cursor on the line and start dragging it down until I find the date for the last day of trading in a particular year. And that'll also give me the price of the close that day. And I do that for every year I have available. All right. The other way you can get it is to go to the company website, to the Investor Relations tab, and you should be able to find the share price closing on those pages up at the website. All right. So you put that in underneath the share price. Then you go to the research pages for balance sheet. Once you're at the balance sheet, you look down into the liability section and you find total debt. You take the total debt number and put it on the row on your spreadsheet. Come back up, still on the balance sheet, to the asset section and find cash and short-term investments. Some companies report this as one number. Some companies report cash as one number and short-term investment as another. And if that's the case, you want to add them together, okay? And put that on the correct row, cash/STI, in your workbook, all right? Now that you have done that, the workbook itself has made 3 calculations for you. The first is market value, and that's where you multiply the DWAS by the share price. The second calculation the workbook made for you is the enterprise value. Enterprise value is the market value plus the total debt less the cash and short-term securities. All right, and I'll say that again. It's the market value plus total debt minus the cash and short-term securities. Enterprise value is what you, as an owner, if you were going to buy the entire company, would have to pay in the market for the entire company today. All right? And with those 2 calculations made, a third calculation is made, and that's return on investment. Return on investment is the operating income divided by the enterprise value. All right? Now, you got all this information, what do you do with it? Here's how you look at it. What you're trying to get is a sense of the absolute value of this company. You look at the trend in operating income. Is it going up? Is it holding steady? Is it going down? You want to know that. In some cases, it might go up one year, down another year, up another year, down another year. You just want to know how the operating income is for the company. Then look at the diluted weighted average shares. Is it going up, which means that you as an owner are being diluted by management putting out additional shares? Is it holding steady? Or is it going down, which means that you as an owner are starting to own more and more of the company without having to buy more shares? All right? And then you compare that to what's happening with the operating income. Then you go over to total debt. You compare total debt to the operating income. Is total debt going up, holding steady, or going down? And is it in the same direction as the operating income? If management is taking on more debt, they should be able to generate more operating income. Okay? You can then compare total debt to the diluted weighted average shares. Sometimes management will take on more debt so they can buy in shares of the company. In other words, raising the leverage factor of the company. Then you look at your cash and short-term investments. Is it going up, holding steady, or going down? That can tell you whether or not the company is generating enough cash to continue to operate. And also compare your cash and short-term investments to your total debt. If total debt has gone up, did you see a bulge in the cash which might be used by management for either renovating the operations or increasing the operations through an acquisition? All right, now look at the components of enterprise value. If the enterprise value, market value of the stock is generally 70% of the total enterprise value, and at this point in time, it has gone down to 40%, is that because the stock market has fallen? Or is it because the debt has risen and the company is more leveraged than perhaps it should be? Okay? You need to just see what the trend is over those 5 years in the enterprise value. Now look at the ROI, and this is where I have a lot of fun. All right. Before you erase anything in your workbook, make a note of it on a piece of paper. So closing price would be such and such for each year. Now go back to your chart and look at the high price of the stock for every year. Make a note of that on a piece of paper. Then come back and look at the low price on the chart for every year. Take that information back over to your workbook, and where you have share price, take out the closing price for each year and put in the high price for each year. And you know what that did? That then lowered your ROI. So now make a note of the new ROI using the high price. Remove the high price for the year and put in the low price for the year. That will increase your ROI. Make note of that increased ROI for each one of the years. And what do you have now? You have a high and a low opinion of the market for this particular company. Average those numbers, and that will get you an idea of just how exuberant the market will be for this particular company. And also, when the market is negative on the company, in other words, the low price for the year, it will get you closer to the intrinsic value of the company. Okay? Look now, take your current market price, put it in the last year of your workbook, which is the numbers that just took place before this year began. See where your ROI is now and compare it to the high and the low ROI. And that's going to give you an idea about where you are in the swing of the pendulum for this particular company. Okay? You can play with these numbers and compare them to each other. And then once you have all of your companies in your workbook, you can see how they also compare to their peers within that particular economic sector. It's a lot of fun to play with and to look at, and it doesn't matter how much knowledge you have, it is also giving you a sense of what value is in that sector and in those companies. All right? Now, go to page 139. I've alluded to many times the fact that the steady cash flow as equal weight to capital appreciation is important. And here's some of the reasons why. On a yearly basis, one or two sectors in the market will decline by around 10%, which means the stocks in those sectors will decline as well. Every 2 to 3 years, the overall market will usually decline 15 to 20%. Once a decade or thereabouts, the market will decline 35% to 50%. Some of the high-flying stocks in the prior bull market will decline as much as 75, 80, 90%. You can use these fairly consistent volatility cycles to your advantage to add companies to your portfolio at prices and dividends that will increase your average annual investment return, AAIR, and your average annual total change, AATC. That's how you use these workbook pages. Now go to page 142, rule number 19. This rule talks about tax swapping. Tax swapping is a legitimate method for minimizing capital gains taxes. However, it has some features to it that can be detrimental to the long-term growth of your portfolio. So you have to be careful, and you have to use your accountant or your tax advisor to help you decide whether you want to do a tax swap or not. But I want to end with an old saying in the marketplace. Don't let the tax tail wag the investment dog. Don't try to save taxes now in this way if it is going to interrupt your investment strategy longer term. That's it for the 19 rules for getting rich and staying rich despite Wall Street. We appreciate the fact that you've been here. We hope that you found it helpful. We wish you much success in your investment program.